done that before.
Okay, you're up.
Awesome. So getting started is on the first slide. So that it's your future, let's protect it. That's the slogan for Farm Bureau, and something that when I very first started the industry, I thought it sounded kind of cliche. But then the more that I've heard horror stories about claims and people being super underinsured, kind of like what Jeff was saying, it's a huge thing in the industry. So we'll kind of dive into that, talk a little bit more about why we want to make sure that the future is protected, not just today, because what happens a year from now could be different than where we're at today. So we'll get into some of that. So I just press a button.
Should be the big one in the middle there.
J.T.Clark with or without an E?
No E.
No way.
No E, just the K. So a little bit of introduction. So I actually came from a construction and oil and gas background. So at some point got tired of getting hit in the face with rocks all day and decided I wanted to get into sales. So I got into life insurance sales in 2017. I really liked the insurance industry, but anybody that's sold life insurance knows that it's a super tough thing to market for. So I decided that I wanted to become a multi-line agent, where I had multiple different types of insurance that I could talk about and sell. So I became a multi-line agent in September of 2019 with Farm Bureau. I started my book of business from scratch, so no buying into books or anything like that. Started from the ground up, and it made me really appreciate how to build a business from doing it that way.
Tell me what a multi-line is.
So a multi-line agent is just somebody that can sell multiple lines of insurance. So I specialize in home insurance, auto insurance, life insurance, commercial insurance, and agriculture insurance. So I also can do health insurance, but personally don't do any of that. I actually refer it out because it's not really my niche market. And then I have two kiddos that you can see in the picture there. So Addison is our 9-year-old daughter, and our son Daxton, who is 4. And then that's my beautiful wife, Alex. It's also an EXP agent. So I'm sure some of you have seen her. So kind of,
You sell multiple lines, but products, or is it just one?
just Farm Bureau. So I have some broker things that I can do. So if it's like out of Farm Bureau's realm or something that's not in their appetite, then I can use brokers. I don't personally like to, because it's bringing in a third party and I'm kind of waiting on them to get things done, and it's not always the fastest process. So I like to stay as in-house as possible for that reason, so that it's like, I want to be punctual, I want to be on top of it and make sure that it's taken care of promptly.
I like that, not in their appetite. I'm gonna start using that.
Yeah,
It's
exactly.
not in my appetite.
Yeah. So kind of getting back to what Jeff talked about with the value versus the price of insurance. So everybody, we see the ads online all the time. They're popping up on our Facebook, on our Instagram, on your TikToks, talking about how, oh, why pay $150 a month when you could call 1-800-INSURANCE and pay $39. And it all sounds really great. We're in a price-driven society, but at the end of the day, like, not a lot of people have an understanding as far as what full coverage is and whether you are going to be fully covered. So in our industry, whenever you go to buy a car, if you're taking a loan out on that car or even a home, they're going to tell you that you need to be insured to full coverage. But their definition of full coverage and my definition of full coverage are going to be two completely different things. So with a bank, when you're buying a car, full coverage is saying that you have a comprehensive and a collision deductible, but the coverage amounts as far as liability limits go don't have to be set to a certain standard. So with me, if you're not fully covered for an accident and you're having to pay something out of pocket, then you weren't fully covered, whereas the bank told you you had what satisfied their needs, but then if you had out-of-pocket expenses because you didn't have enough insurance, then didn't really work out. So we're going to talk a lot about kind of the value of having value in your insurance versus just the premium, because everybody sees the premium that comes out of their bank account every month or every year, however you pay it, but not everybody knows exactly what they have, kind of like what Jeff was talking about. So knowing limits on the auto side. So anytime that you're in an accident that you caused, there's going to be two different things that could pay out. So that's going to be bodily injury and property damage. So bodily injury is any injury sustained in an accident that you caused. So you rear end somebody and they said that their neck hurts a little bit of whiplash. That's going to be a pretty minor claim for bodily injury to something as extensive as a life-changing injury. So somebody has to have multiple surgeries. If they're never going to be able to walk again, something of that nature, that bodily injury side of your limits is going to be through the roof with how expensive bodily injuries are becoming with surgeries, doctor bills, hospitals, transportation to hospitals. All of those things are going to fall under those liability limits. And then your property damage is going to be any property that is damaged that you cause. So most commonly we're hitting another car, but that could be hitting a street sign, a mailbox, a federal building, anything that you're physically running your car into is going to run into the property damage. So that's one where my rule of thumb with your liability limits is always at least have enough on your property damage to fix the newest car coming off the lot. So here in Utah, I don't know what it is, but I feel like I see at least 5 Teslas every time I go to drive somewhere. So I like to use those as an example. So those could range anywhere from $60,000 to $100,000 for that car. So if we have John Doe driving his truck, he hits a Tesla, and let's say that Tesla is a complete and total loss. So it's not going to be able to be fixed, not going to be able to be driven again. It's going to be totaled out. So if John hits that car, the car's totaled, he's at fault for that, and he has to have enough insurance to cover to replace that vehicle. So where you see that state minimum coverage there at the bottom of the slide, so just a brief explanation of that. So the $25,000 is the minimum that the state of Utah requires you to have in coverage for bodily injury. $65,000 is per occurrence for bodily injury. So that's if multiple people were injured in an accident. They're not going to pay out more than $65,000 for one accident. So if 3 people were hurt with 25 grand in damage, they didn't have enough coverage. And then the $15,000 is property damage. So I see a hell of a lot of cars driving out on the road that are worth more than $15,000. So in my opinion, the state of Utah needs to bump those numbers up drastically, but at the same time, it works in my favor because a lot of people that I talk to have these state minimum coverages and have no idea that's all that they have. So it's a huge focal point for me to make sure that you do have those numbers. So if John had the state minimum coverages, he totals that Tesla. So we're going to pretend that this person walked away with no bodily injury. We're just going to talk about property damage. So if that car was worth $70,000 and it was completely totaled out, John's going to get a check from his insurance to send over for $15,000. Now that other $45,000, $50,000 that in damage is actually going to be on John. So the insurance gives a check 15 grand, washes their hands of poor John and says, sorry, Charlie, but you're at fault for the rest. And he has to come up with $50,000. So if John doesn't have $50,000, a good attorney is going to come after John and they're going to go after his assets. So now all of a sudden, John went from thinking he was just in a car accident to potentially losing his home, losing his vehicles, losing things that he has to his name that have any sort of equity or value. So that's the risk with not having proper insurance limits when it comes to your auto and bodily injury side. So if you have not reviewed those types of things with an insurance agent, that's something that I recommend definitely doing because you want to make sure that those coverage limits are adequate and up to par on the auto side of things. So before jumping into home insurance, does anybody have questions about the auto insurance, bodily injury, anything on that side of things?
So what do you do with clients when they come in and they say, just give me the minimums, like you just portrayed right there? What's the next conversation?
Personally tell them, so I obviously want to explain the value of having more. If they're still like, I just want the state minimums, I tell them that we're not a good fit for each other.
You told me about John.
So tell them about John. If they're still like, nope, I want the state minimums, I just say, we might not be a good fit for each other and refer them out to State Farm because they might do it. Just kidding if anybody likes State Farm. Eric.
Maybe you'll touch on this later. I'm just kind of curious on after those, your limits expire. Is that when umbrella kicks in or?
Yep. So I'm actually going to get into the umbrella here in a couple of slides because that's one that's also very important that we'll talk about as well. So underinsured and uninsured, sorry, I didn't touch on that. So underinsured and uninsured is just essentially saying that if you're involved in an accident that you didn't cause, so let's say that somebody had the state minimum coverage and they ran into you and your car is worth more than $15,000. So that's just saying that your insurance would actually kick in to cover the remainder of the damage of the accident. And then the insurance company is going to turn around and go after the driver. So it's essentially taking the headache off of your shoulders and putting it on the insurance company. So we'll use John again. If John only had $15,000, but there was $50,000 in damage. So that other person that was hit in the accident's insurance would turn around, cover the remainder of the damage as long as you had enough limits to cover, enough liability limits to cover. And then we turn around and go after John for the remainder of the damage. So John still has to pay it. His assets and everything else are still up for grabs. It's just making sure that you don't get strung out in the process and not getting your car replaced for however long it takes before the money comes through. So thanks for pointing out that I didn't talk.
I like your
about
choice of car, man. It changes the whole presentation if it was in grapes.
it. Yeah, so you hit a Lamborghini.
Smart marketing
then
there, bro.
So
Yeah, don't take the
that'll-
Lambo around.
That'll tie back into the umbrella for Eric on that. All right, so deductibles. So this ties in with how we were talking about the difference between having liability only versus full coverage on your car. So full coverage in the state of Utah, you have to have those state minimum limits that we were just talking about with the $25,000 in bodily injury, $15,000 in property damage, and then shows that you have a comprehensive and a collision deductible. So that's all the state of Utah wants you to have for you to legally be driving. So when people go buy a car, if they're being referred to an insurance company when they're buying a car, a lot of times they're just being sent to a company that's just going to satisfy the minimum requirements with the cheapest premium possible. So that's what we're trying to avoid and educate people that that's not always the best strategy to have. So the main difference between comprehensive and collision is comprehensive is going to be everything that a collision is not. So it's going to be like your weather claims, any type of damage like vandalism, your car being stolen, your car being broke into. Those things are going to fall under comprehensive claims, and those are not going to have as big of an effect on your insurance premiums. So where I say that I recommend having your deductible between $100 and $500 on comprehensive, my biggest reasoning for having that is mostly for glass claims. So a lot of insurance companies back in the day would include glass in their comprehensive where you didn't have to pay anything. It was a zero deductible for glass replacement. I'm not seeing that anywhere anymore. So glass has gotten so expensive with the technology that manufacturers are putting into vehicles that it is now going under your comprehensive deductible instead of being covered without having to pay anything for your insurance. Because we'll revert to that same Tesla that I was talking about. Any Tesla owner knows that your glass starts at the front end of the car and ends at the back end. So it's not just replacing a windshield, you're replacing an entire top end of a car, and it's easily upwards of $3,500. So if you have a super high deductible or no deductible at all on there, then you're going to be paying that out of pocket. So I recommend having it between $100 and $500 to drive down that out of pocket expense, and it's not going to increase your insurance premiums next year at renewal. The collision claims are going to have an effect on your insurance premiums. So my rule of thumb with that is having it set at $1,000. So even if you call your insurance company to make a claim, you cause an accident, if they take it to a body shop and that damage is $1,000 or less, I'm going to say, don't claim it on your insurance. Pay it out of pocket and get the car fixed. Don't claim it on your insurance. And then it's not going to increase your premiums for 3 to 4 years. Because if you looked at the math, like based on paying it out of pocket, just $1,000 versus having a lower deductible, 9 times out of 10, you're going to pay way more for the increase in premium than you would have if you would have just paid the $1,000 out of pocket. So having the collision deductible at $1,000 and then the lower comprehensive deductible is kind of my rule of thumb. And then kind of like on the graph right there, if you're messing with premium and trying to save a little bit of money, the lower the deductible is, the more expensive the rate is going to be. So higher premiums for lower deductibles. If you want higher deductibles to save a little bit of money on the premium, that is something that you can do. I don't always say to, like, if you start talking about going over $1,000, that's a pretty big out-of-pocket expense to make a claim, but it is something that you can always do if you're trying to save a little bit of money on the monthly premium. All right, so home insurance. So just like Jeff was saying, this slide's for him. So the most common thing that I'm seeing in the industry right now is homes being very, very, very underinsured. So as homeowners, as real estate agents, like we get really excited talking about how much equity people have in their homes, but we're not talking about how to protect that equity. So the most common thing that I see is somebody buys a home, ties their mortgage or ties their home insurance to their mortgage and escrow payment. So it's just being paid monthly out of your mortgage. They're sending out a check annually to the insurance company, but they're not checking the limits on what the home is. So if you bought your home 5 years ago or longer and you haven't reviewed this, insurance agents aren't just doing this automatically without talking to you, because it is an increase in premium to raise stuff. So no insurance agent likes to call their client and be like, hey, your insurance premiums are going up $250, $300 this year, but here's why. So if you haven't reviewed these things within, I mean, really within the last year, I would be willing to bet a lot of money that you're pretty significantly underinsured. So that's kind of where it comes into having an agent, not finding the online insurance or calling 1-800-insurance or Googling the best rates. You want to have somebody that sits down and goes over these things with you, because that's the risk that you take. Like Jeff said, $100,000 underinsured. Like I'm running into people that are 250,000 and more underinsured, where they've had the same home for 10, 15 years, never reviewed it. It just comes out automatically and they don't think about it. It's out of sight, out of mind. And then that really bad tragic day comes where if the home did burn down and they didn't have enough coverage, the insurance company, like we talked about earlier, is going to cut a check and say, sorry, it's not my fault that you didn't have enough coverage. Like you didn't call to review it. They're going to push the blame on you, unfortunately. And that's why it's important to make sure that you do have those adequate coverages. You're reviewing this every year, because if something did happen in your home as a total loss, you want to make sure that you're getting your money back. So we all love the equity. We all like to save money, but call your insurance, make sure that you have those numbers hiked up to today's replacement cost. And that's also something that I offer to do at no cost, as a replacement cost evaluation on your home, so that you know that your coverages are where they need to be. So
I just want to make a comment on this. Some of you have been sending out CMAs to your clients because of the Thursday trainings we're doing and helping them get rid of mortgage insurance premiums because they've got equity, stuff like that. This would be another great touch with your clients. I just took an insurance class and I learned that many homeowners are underinsured. Reach out by offering value, not expecting anything in return. I know a guy that can do a free rebuild cost, what you call it, replacement cost analysis on your home. That could be huge. I mean, just the fact that you bring it up, you know, you're getting credit as being that advocate for them. And that's why we do these trainings. Use this as a touch, call them, send them an email, send them a text or whatever. And they'll go, oh shit, I didn't think of that.
yeah. And then just to touch on something with that. So one thing I've realized after getting my real estate license is that my replacement cost evaluation and a CMA that you do are never going to be the same. So my replacement cost is always going to be less than your CMA, because I'm not taking the lot size or the market value into effect. I'm just saying, like, what would it take if we had to rebuild this home from the ground up, all the labor, parts, and material, and that's going to be where I get my number rather than the craziness of the market and everything else.
This stuff is expensive right now.
So if you do ever ask me for one and I'm $50,000 or $100,000 under what you have as the home value on the CMA, that is completely and 100% normal, because we're not taking the lot and the market conditions into effect on a replacement cost. But with how expensive lumber and stuff has been, it's still, we end up pretty dang close on the number side of that. So a couple of home insurance add-ons. So I don't know if Sydney's on, but she'll like this one if she is. So one of the biggest things is an inflation guard. So kind of like we were talking about homes being underinsured, one of the things that I am very high on right now in the market is a 25% inflation guard. So if your home's value is at $400,000 today when we go through to do your insurance, and I add a 25% inflation guard, your home's actually insured up to $500,000, which covers that time between when you signed up for the insurance and when we talk again to do a new evaluation. So if that home went from $400,000 to $450,000 in value over a 6-month period, and then something happened and a claim happened, the homeowner is going to know that they have adequate coverage with that inflation guard. So with how things have been going in the market, it's a huge tool where I would say 100% of the time to have an inflation guard right now. It doesn't add a lot in your premium, but it does add a lot in value for if something like that did happen. Scheduled personal property. So a lot of times people will put jewelry, firearms, things of high dollar value like collectibles as a scheduled personal property. So anytime that you have a basic homeowner's policy, there's going to be a scheduled limit for personal property. So like jewelry is typically around $1,500 to $2,500. So if you've got a nice wedding ring, nice necklaces that are worth more than that, you want to schedule that on your policy. So it does take an appraisal to do that. So if somebody had a $10,000 wedding ring, wanted to make sure that it's covered from being lost, stolen, damaged, anything like that. So I would require an appraisal to do it, but I would always recommend doing it because it's only going to cost 10, 15 bucks a year to schedule that thing. And you're covered for if it gets lost, kid throws it down the drain. We've seen some crazy things with how things can be damaged on there. So if you have any sort of collectibles or high dollar value items, always schedule it on there so that you're getting the full value and a ran down number.
Just to understand terminology, we see scheduled purposeful property versus purposeful property because it's specific.
Yep, exactly. So like most of your collectibles, so sorry to touch base a little bit on that question. So most of your belongings are gonna have a set limit based on what it is. So like your appliances and things like that are gonna fall under your personal property that you have on your insurance, but anything of higher dollar value. So you wanna schedule it specifically so that you're getting the correct amount for it. So the most common things are gonna be your jewelry, firearms, fine china, and collectibles, where in your fine print in your insurance declarations, you're going to see that there's a set limit per item on certain things that fall under that. So if it doesn't have a set limit, it's whatever the replacement cost is of the item that you have. But if there is a set limit on your insurance, which jewelry, collectibles, firearms, those things in every different company are going to have a set limit. And it's usually between $1,500 and $2,500 is the max that they'll pay out. So if you had 5 pieces of jewelry over $2,500, and so that's $10,000 worth of jewelry, and you get a check for $2,500, you're going to be upset that you didn't get the full amount replaced. So that's where it becomes important that if there are those limits, which 10 times out of 10 there are. What's that?
Is that art?
Yeah, so any type of art, especially if it's a high dollar value item, because if something burns down and you don't have something showing that that thing was worth that much value, it essentially becomes your word versus theirs in that situation. Whereas if you got the receipts, then something showing the value, then it's always going to be replaced. So good question, thank you. Ordinance of law. So this one we see more often with older homes. So it's going to be your scheduled city and county codes. So if the city county comes in and says that your wiring, something like that isn't up to date and they're requiring you to replace that and bring it up to today's standards, ordinance of law coverage is going to cover that. It also helps out, like if a tree root is growing underneath like a sidewalk and they're wanting you as the homeowner to replace that, you don't have an HOA or something like that, that helps out. Ordinance of law is a coverage that's going to help out with that. So having between $10,000 and $25,000 in coverage for ordinance of law, I would say to add on to every home, even if it's newer, because it only costs about $10 to $20 a year to add it on there, and it could be a hidden value for any sort of claim with that. Water sewer backup. So I saw a post that Sydney made last week about water sewer backup in her new beautiful home. And so this is a big one. So these are all exclusions in homeowners insurance on your basic policy. So any type of sump pump backup, backup with your drains for water sewer backup is not going to be covered on your home insurance unless you have an endorsement on there. So always making sure that these things are added on is huge, because we see it all the time with certain backups. If you had like a flood come in from outside from a rain or storm, that's going to be covered on a standard home insurance policy. But if it's a backup from a drain, then it is not going to be. So make sure that you guys definitely have coverage on that. Earthquake coverage became a very hot topic about 2 years ago when we had all the earthquakes in Utah, and then I haven't heard anybody talk about it since. So it's like our phones blew up for a little while because everybody wanted it. But then when they realized that it doubles your insurance premium to have it, it became not as exciting. I personally, like with how deductibles and stuff work on earthquakes, they work a little bit differently than a standard home insurance deductible. So I'm not a huge fan of it unless you are right in the middle of a fault line, like over in certain parts of West Jordan, Magna. Like there's certain areas where I feel like it's important, and others where I don't think that we would have a significant enough earthquake, but I also don't want to be the guy to say don't have it and then something happens. So that one's kind of a personal thing. If you're really worried about it, it's a great coverage to have. If you'd rather save money on premium and don't think that, like think on the analytics side that we haven't had as big of damage from that, then it's a good spot to save money.
JT, would that also depend on the amount of value you're covering? I mean, if
Yes.
you've got a $200,000 house versus $2 million house, that might be a determining factor, right?
Yeah, most definitely. So if it's kind of like where I was touching, if it's a worry and something that gives you peace of mind, like insurance is all peace of mind until we have to use it. So I would say that if you are on one of those fault lines, it is a higher dollar value. By all means, yes, like look into it, but kind of a rule of thumb, it is going to double your premium. So it's going to be maybe a little bit less than double in certain situations, but if you're paying $1,000 a year for your home insurance, if you added the earthquake insurance, it's gonna be about $2,000. So it's a pretty expensive thing. And then the deductibles work differently. So instead of having $1,000 or $1,500 home insurance deductible, it's typically gonna be 5 to 10% of whatever the home value is for the deductible. So they make the deductible really high, so that if you have a $1 million home and you have to pay 5 or 10% before your insurance kicks in, even like that's a huge out of pocket expense to pay before insurance even covers it. So that's where I see a lot of people like, yes, I want earthquake insurance, but then when you kind of explain how the state has regulated earthquake insurance, you have to pay a lot of money before it'll
You know what I
even.
would say to that? Add up all your Starbucks and tell me how that compares to your $1,000.
No, I would agree. I would agree 100%, because $1,000, like it'll add $80 a year to your home insurance. So $80 to
Reduce it
protect
to the
a
ridiculous.
million. Like I agree with you. I'm gonna say I'd rather somebody pay more and have the right coverage than save money. But at the same time, like if I always kind of leave that one up to the homeowner on that one. Fridge and freezer contents, so another one that's excluded. So if you had any sort of power outage, anything like that, your fridge or freezer contents, if they start to molt and go away, I always recommend having at least $1,000 on this, because it's like $5 a year to have. And then if you do have any sort of power outage, if that stuff goes out, it replaces all the meat, especially like people that carry a lot of different things in their freezer. That can be a huge one for a really cheap cost on there. Yeah. So any other questions on the home insurance add-ons?
What's the residential equipment thing?
So residential equipment breakdown is going to kind of revert back to the power outages. So anything that's plugged into the wall, if there's any sort of like a claim from lightning or power outage and those things are damaged, it's going to replace that equipment up to $100,000 in coverage. So that one's a set rate at $40 a year. So it's a really cheap one to have for good coverage for that kind of situation as well. Adding an umbrella. So getting back to Eric's question. So an umbrella coverage is going to be in increments of $1 million in liability that's going to extend out over all of your assets. So in my opinion, anybody that owns a home, owns at least one car, so 2 assets or more, I'm going to say that having an umbrella is a huge add-on to having your insurance, because it's going to add just that much additional liability. Because kind of like we talked about with the bodily injuries and things starting to add up with how expensive doctor bills can go. One of the stories I heard, so not from one of my clients, but within the industry, was there was an accident over by the University of Utah. A young student was hit by a car. I want to say it was like around 10 years ago. And that student was no longer going to be able to walk again. So that injury is falling back on the driver under the bodily injury claim. That driver actually had an umbrella policy. So to have an umbrella policy, you have to have at least $300,000 in coverage limits on your auto side. And then $1 million is going to be added to whatever that limit is. So that person actually had $1.3 million in coverage for bodily injury with the umbrella. So when that injury happened, so they obviously went to court and different things because of how extensive the injuries were. And when that attorney saw that there was an umbrella coverage with the $1 million, so rather than being a long hash out, drag out court system, they ended up settling at $1.3 million. So the insurance company hands out the check for the maximum amount of what their coverage was. The person that got the injury had the $1.3 million in coverage, and it was a wash. So obviously that person's insurance premiums are going to go up quite a bit from the claim, but that was what the insurance was there for. And umbrellas are actually really cheap to have. So a standard homeowner that has 2 cars, 1 home, you're looking at maybe $200 a year in addition to your premium. So less than $20 a month to have an umbrella. The more assets you have, the more that number is going to go up. But for the value that it can bring, it's going to be huge. So the biggest things that you're going to see that with is bodily injury claims. You're not going to see it as much on the property damage side of things, but in those life-altering injuries that we hear about are multi-vehicle pileups that happen in the wintertime. So those type of things an umbrella will kick in to help out with. And 9 times out of 10, if you have that, it is going to be settled in court at that insurance limit, unless obviously we were talking like a super high, like high net worth individual kind of thing on there. And as business owners, I always recommend having an umbrella, especially if you have any sort of advertisement on your car, because you get in a little fender bender. I got Farm Bureau written all over my truck with my name and phone number on it. If I hit somebody and they've got a little bit of neck pain, their neck's going to hurt really bad when I hit them, because they're going to see that. Unfortunately, dollar signs are going to go off. We see it all the time where people aren't that hurt at first, but then they see that who hit them drives a really nice car, is a higher net worth individual, and all of a sudden that neck pain ends in, oh my gosh, my back hurts so bad, I'm never going to be able to work again, kind of thing. So there are situations like that out there. So having that umbrella for a cheap amount is always something that I would recommend on there. Any questions on the umbrella? I know I kind of went through that rather quickly. Awesome. So life insurance. So anytime that I sit down with a client that has assets, we want to talk about how to protect those assets. So life insurance is kind of the entry point of where I got into the industry and something that I have a lot of passion about, from family situations and different things like that. So just to kind of touch on a story real quick. So when I was in 5th grade, my grandpa was actually diagnosed with cancer, wasn't going to live. He was terminally ill. He told my dad and my aunt that he had a $500,000 life insurance policy through his credit union, not to worry. He was also a business owner, so he's going to hand down the business, had this fat life insurance that was going to pay out whenever he passed away. So they were under the impression that they didn't need to worry about anything. Well, he passed away. They go to cash in on the life insurance, turn in the claim on there. And what he had was actually an accidental death and dismemberment policy through the credit union. And so since he passed away of cancer and not an accident, that insurance policy didn't pay out. So what they thought that they had and was coming to them as a family ended up not being there, and he had no idea. So we see the advertisements every day, kind of like the car insurance, the get coverage for $10 a month for this or for that. It's not real. Like it's not. If you're paying less than, in my opinion, $50 to $100 a month for life insurance, it's probably not the right type of life insurance that you're looking for. So having somebody that'll sit down, review the policies with you, make sure that you have exactly what you have, and knowing what you have is something that's super important. Same thing with a work insurance policy. So one thing that I always recommend is that if it is offered through an employer, to max it out, because that's going to be the cheapest place that you're going to find it, because it's a group insurance policy. But that same person, how we're talking about terminal illnesses, if they're diagnosed terminally ill, let's say they have 12 months to live. So if they've got 12 months to live, they're obviously no longer going to be able to work at some point in that when things are going detrimentally downhill. So when they go to leave their job, they have things like COBRA insurance that can help out with the health insurance side, where we're able to carry those benefits with you as an individual once you leave your job. Most life insurance companies, it's not the same. So as soon as you leave that job and you stop working, even though you were diagnosed with a terminal illness, that life insurance goes away. So now you're set with a death sentence with no money to leave behind for your family. So my rule of thumb that I always say is have something that you own personally outside of work that you have ownership in. That way you know what it is, you know what it has. And if you pass away and you have too much life insurance, your family's not going to be upset. But if you pass away with no life insurance, your family's going to be left in a pretty big financial hole. So making sure that you have those types of things is huge. And I talk about this all the time. The insurance for your cell phone, people add it on all the time for something that's at $800 to $1,500 in value, and it probably costs just as much as $100,000 in life insurance. And people see life insurance and they're like, oh no, we don't want it. We don't want to talk about it because it's a touchy subject, because talking about death is never fun. But make sure that your family is going to be well taken care of, especially if you're a breadwinner of the family. My rule of thumb is having around 10 times your annual salary is going to make sure that if you have a significant other in a family, that you're going to be they're going to be well taken care of if you're no longer here.
JT, I've always thought of life insurance as income insurance versus asset insurance. Is that an accurate perception?
I would say that there's multiple different things that people use it for, and I'll kind of touch on that on the next slide too. So I would say that you want to have enough to protect your assets plus protect your income, because especially like in a family where, let's say, dad works and mom doesn't, or vice versa, mom works and dad doesn't. So I get this conversation a lot where, okay, well, wife's home, she's a homemaker, like she doesn't need life insurance on her. I just need life insurance on me as the breadwinner. I would argue and say that she needs just as much as you do, because if something happened to her and she's at home watching the kids, now what are you going to do? Are you going to stop working? Are you going to only work part-time? Are you going to have to hire a nanny? Like, how are you going to replace what that person does and what that person brings to the table? So it kind of ties into it's kind of a buy scenario. So I would always say your asset protection is something where if you have multiple lines of credit on, like homes, cars, different things, always have enough by all means to pay off your assets. And then your income is going to be the next thing that we want to talk about. So if you're paying off your assets and then giving 5 to 10 years of your income replaced, that's making sure that your family doesn't have to throw a sign in the yard to sell it once the breadwinner passes away, and at the same time replaces the income so that they don't take a fall financially from losing a lot.
Yeah, when I do that calculation, I always think of it as income that would pay off those assets, so
So you could,
I see what you're saying.
you could in theory just say that you're using it as an income protection if the income is going to be used to pay off the assets, but just from seeing like studies that they've done within the industry, that money goes away really quick when it's paid out in a lump sum. So paying off more than what you would expect, or paying out more than what you would expect, is always going to be better than.
No, I was thinking of the way where I didn't lump them together, but I lumped them together on income, meaning you add your liabilities into that income so you can pay it.
Gotcha. So yeah, so I
But
think
yeah, I see what you're saying.
definitely. So some of the two most common types of life insurance that you're going to see in the industry are term insurance and permanent insurance. So some pros about term insurance is it's the most affordable form of life insurance. It's always going to be something that's temporary. So most commonly 10, 20, or 30 years. Once that term is up, the insurance is going to go away, or you're going to have to re-qualify for it. So if you qualify for it today at 40, on a 10-year term, you have to re-qualify at 50. So if somebody's diagnosed with, we'll say, the terminal illness again at age 49, and their insurance is going to expire at age 50, so they turn 50, the insurance goes away, and they no longer qualify for the life insurance to reapply. So that's kind of the high risk with term, is it's temporary, and the chances are it's not going to pay out because it's built to either outprice you in your latter years if you live to be old, or built to expire before the death actually happens. Anything that you see through an employer is going to be a term insurance 9 times out of 10. And like we talked about, it does go away at the end of the policy period. So that's just something where it really comes into play with, like, if you have a 30-year loan on your home, I would always say if you're having coverage to protect your assets, term insurance is great for that. Throw a 30-year term on it so you know that if something happened in that 30-year term of owning the home, that the home is going to be paid off with the term policy. But I like to supplement things to where I have kind of a combination of term and permanent. So I think that there's a need for both. Permanent insurance is a level premium benefit. So starting off, it's always going to be more expensive than term to get a permanent policy, but it's going to be level. So if you're paying $100 a month today, it's going to be $100 a month until the day that something happens to you, rather than having to requalify and those premiums going up every time that you do. They also build cash value. So we see a lot of like high net worth individuals and business owners use permanent insurance to actually supplement their retirement because it's tax deferred. So you can use it, like some products work just like IRAs, where you can put into it, but without the maximum amount. Like with an IRA, you can only put X amount of dollars into it a year. If you have the right permanent life insurance policy set up, you can actually put as much as you want into it, take advantage of the tax deferred premiums. And if you have homeowners that have this, you can actually turn around and use that money. So you're like taking a loan out against yourself without having to pay it back to put a down payment on a house or buy another asset. And then the one con, and really the only con that I have with permanent insurance, is just the expense. It is going to always be more expensive than term insurance on there. So I know that's kind of a brief explanation, but I don't want to go too far over time. So any questions on the life insurance side of things?
You guys have anything on Zoom, you can just unmute yourself.
Awesome. And then this is kind of how I tie everything back in when I'm sitting down with a client with the Your World presentation. So income, we're always going to talk about what you do on an annual basis. This kind of ties back into the life insurance side and how much we want to make sure your life is protected. So as you can kind of see, there's a shield around this person's family. So we talk about their family, we talk about their assets. This is something that I'm going to talk with everybody that I sit down with, making sure that we've got adequate coverage on the family, adequate coverage on the assets. And then as you can see at the bottom, those are going to be the key points on making sure that that world is protected. So health insurance, like I said, that's something that I use as a referral. So I refer it out to somebody that specializes in it and gives them the best product for their family, along with disability. I like to tie that with a health insurance. Life insurance and longevity, that's something that we can pair together to do. So always something that's a key point to talk about. And then obviously your home, auto, and umbrella are the main reasons that we got to sit down about your coverage today, so those are going to be the highlights, but that's going to be the presentation on making sure how we talked about it's your future, let's protect it. That's how we're going to do it, is by making sure that we go over everything in complete depth. Because kind of like we talked about before, if you don't have an agent that sits down and goes over this information with you and you're just signing up for it online, most of the time there's going to be a couple of different things on here that weren't talked about, weren't covered, or you might not have known weren't covered. So it's good to have the education side of it. We have another question on there.
Yeah. Do you do homeowners insurance for the flip properties?
Yep, so we would insure it just like a basic homeowner's insurance policy while you're the owner of the policy. And then obviously once you turn around and flip, as you're adding value to that home, it would be a conversation that I would want to have with that person regularly that's doing the flip. That way, if we said right now when it's completely gutted, it's only worth $250,000 to replace, but then that number turns around and goes up because of the adjustments that you've made, I would want to make sure that we were staying in touch to keep tabs on that. So rather than just talking to an insurance agent once a year, somebody that's doing a fix and flip, we would want to make sure that they were talking to their insurance agent a little bit more regularly to make sure that those numbers stayed up to par and that we were adjusting it as you go.
So what do? Do they pay an annual premium and then do they get any money back if they sell?
So
it in
I would
90 days?
always recommend doing a monthly premium if you're doing a fix and flip instead of an annual, rather than having to pay annual, get a refund later, pay monthly. That way, like, you lose a little bit on a discount from paying monthly versus annually, but then you don't have to deal with any of the refund or anything like that after you sell. You just cancel the insurance once it's sold, and then you don't have to worry about it anymore.
Reset it. So
Sorry.
there you go.
All right, so kind of talking a little bit about Farm Bureau and the company I represent. So anytime that somebody's shopping insurance, I always recommend shopping more than the premium. Shop their financial strength, shop their claim service, shop the things that are going to be most important when the bad day comes, instead of just what's going to be coming out of your pocket monthly. So make sure they've got excellent financial strength. For multiple asset owners, we offer a one policy, one deductible premium. So if you had more than one home on one home insurance policy, with other companies, let's say that a really bad hailstorm came through. So if you had 5 properties and all of them had hail damage, then you're going to pay deductible for each one of those homes for the insurance to kick in. So it ends up being $5,000 to $10,000 before your insurance kicks in on every property. We offer one policy, one deductible, whereas if your home deductible is $1,000 on each home that you own, you pay us $1,000. We cover the damage on all properties on there, as long as it's coming from the same storm. Same with vehicles, fires, kind of tying it into that same thing. If your home burned down, you had 3 cars in the garage. With every other company, you're going to pay a separate deductible for each asset that you have insured. One policy, one deductible eliminates that. And then the one-stop shop, we do it all. So we also do financial service products. I'm not specifically licensed to do things in the marketplace, but within Farm Bureau, we have financial representatives that are. So we're able to kind of keep not all eggs in one basket, but all chickens on the same farm when it comes to that. And then the annual super check review is something that I do with all of my clients. So whether that's something as simple as a phone call to make sure that we have coverages up to place, to if we want to sit down and go over things. I like to do things annually to make sure that when those adjustments need to be made, that we're going over it. Because like I said, when Jeff went to increase his home value after the claim, when you increase value, the premium is going to go up. So it's not fun telling people that they got to spend more money, but it's good to at least educate and make sure that you know that you have peace of mind, that you have the right coverages, in fact. And then you also get me as an agent if you choose Farm Bureau. And then here is my contact information. And then a quote that me and my intern found that I really liked about value. So it says, the more you focus on the value of your product or service, the less important the price becomes. Because if we can talk about making sure that you have peace of mind knowing that your assets are properly covered, at the end of the day, the premium makes a little bit more sense as to what you're paying for, rather than being a nuisance that you see and wonder what the heck it's for. So any other questions before I go, guys?
Anyone on Zoom have anything? Dude, that was awesome. Good information. Take a screenshot of his contact information there. I really think that if you want to build a relationship, maybe reach out to your clients and ask them if they're insured and kind of see where they're at. Let them know that you're just looking out for them because the knowledge you just gained, it's a big one. I threw that out as an example, and it wasn't even in this rising market. It was just because of time that I was underinsured on that property. And so I think that's just a great value you guys can do to reach out. And so what would that look like if they wanted to connect with you to do what you call it, a super check?
A super check. So yeah, I would just review their current insurance, go over kind of what I would say about, because I always say like, it's not a one size fits all. So kind of make sure that your insurance is tailored to you. So whether it's you coming to Farm Bureau or me just saying like, hey, you've got a great rate where you're at, but here's a few adjustments that I would make. Like I try and make it as personable as possible so that you know that you got what you need.
Cool. Debbie, you're up. We have a sponsor in the room. Most of you know Debbie. She's a regular around here. We love her. I remember that I called her, what I say, proof that warriors come in small packages one time. And she sent me a love text. She loved that. So I'm going to mention that again. She's awesome. She really is a warrior. She works really hard for her clients and for herself. She's got a pretty interesting backstory. And knowing her strength and stuff is part of what I love about her. So get to know her a little bit better. She's going to talk about her mortgage company, Security Home Mortgage, and an event that we're doing together in July that's coming up.
Yes, and I have a surprise event to invite some people to.
Okay.
You'll love it though.
Okay.
I'm not springing stuff on you, but yeah, I'm Debbie Hart. I'm with Security Home Mortgage. I just love what JT said about not using some random online robotic thing because you never know what you're actually going to get, right? So we need to be doing our job right. If the right real estate agent and the right lender and the right insurance person actually affects this person's financial future, right? I mean, you just had an offer almost go south. Can I mention the story?
Sure.
Okay. Because the other agent didn't actually do their job right and almost lost the person their earnest money. Over a simple mistake that would you say she should have actually?
100%.
I would say that too. I would say both the agent and the lender should have known before presenting that offer that they could not cover that appraisal gap. So, and they didn't present that. And so luckily the agent did step up to the plate and offer her commissions to cover her mistake. But these are the things so we must be doing our job right. This is a relationships business. And if you're the agent and the lender and the insurance team working together, if we do our jobs right, we are creating a financial secure future for these people. We are saving marriages, we are preventing divorces, and we are creating a better financial future for their children. So it's really important to have a good team and people what they're doing. I mean, the same thing just recently happened to me. I had a real estate agent send me a quote from just some online credit union, and he thought, this just doesn't seem right to me. It seems too good to be true. Labeled a first-time homebuyer program. You guys were here when I was chatting with him about that. and I looked at it and I said, well, he thought it looked like a great deal because it was 0 down and no PMI. I'm like, if it sounds too good to be true, it probably is. So I said, yeah, I would be happy to look at this for you, no problem. Whether they use me or not, I just care about my clients and I care about the relationships I have with my referral partners and their clients. So I looked at it, and what they were doing is they're just compensating for it in another way by raising the interest rate more than a full point higher than the standard rate for that day. And so this is why you want to know who you're working with, a person rather than a robot, someone online, because we'll take them just like you're doing the interview process. Where do you want to live? What are you looking for? Why is 4 bedrooms important for you? We're doing that interview process for the loan. Let me see the full picture. How much do you have set aside? Would you rather use that all for your down payment and have a lower rate? How long are you going to stay in the home? Or do you prefer to have some reserves? What are your long-term goals? Are you going to be doing real estate investing in the future? These are all the things you want to know so that you can get them the best options possible. So I looked at his whole financial picture and saw that he did have the ability to put 3% down, which would have dropped the rate more than a whole point, saving him $440 a month right from the get-go, even with PMI on there. In a short amount of time in this market, PMI drops off, so he's saving more than $500 a month. And he did plan to stay in the property for the life of the loan, 30 years, but a minimum of 15. So over the life of the loan, the difference is $158,000. What do you think he could do with his financial future and his kids' future with that extra $158,000? Buy 4 more properties or many, many other options, right? So it is important to know and trust and have a good team on your side. Someone that will meet with your clients and talk about all of their options and educate them so that they feel empowered to make their own financial decisions as well. So Jeff mentioned that we are doing this event together coming up, and it's another guy that I've got on my team. He's my financial advisor. He's also a TEDx speaker, and we're also in a rock and roll band together. So I'll just plug that.
I'm glad you added that to the list.
Yeah, he's like, we should get new cards, and he's Debbie and her rock and rates, and me and anyway, it's just but it's fun. But no, he's a great guy, and he does the same thing. He has a software program. You can only get it by working with a certified wealth advisor, but he does offer it to me and my clients and my referral partners for free. And so we're going to do an event together, and it will actually show them a plan for their retirement, and they can plug in their actual numbers, just like I do when I'm meeting with someone about their loans, plugging in the actual numbers, showing them their actual options, and the software will show them if they are going to be able to hit retirement or not in black and white numbers that they cannot dispute. And then it will show some options for how to help them with certain loan products, buy a property every 1 to 5 years, and how that will affect their retirement. And they watch the numbers actually change before their eyes. The difference in being able to retire or having to work until you're 97 years old. So we're going to be doing that event together July 14th at the Salt Lake Community College.
Yep, the Miller campus.
The Miller campus. Yeah, so we're going to be doing that. So I'll just really quick, his lunch isn't here yet. She's on her way. I told her to be here at noon. So he ended a little early. It's not my fault, it's your fault. We gotta blame somebody. So that's okay. I will just, we could. I have 2 more things to
So let me
share.
make one comment. Speaking of lunch and stuff, not all of you are registered to be here, so you don't get lunch. No.
Yes, you do. We really do.
It really does help with our sponsors though, when we know. how
+1
many
for
people
the
are-
next 5 weeks.
Because we
It
kind of
does,
have to
yeah.
guess if you don't register. So
Yeah, I
we love
called her
having you
ahead
guys.
of time. She said 10 to 15, so that's what we ordered, and that's what we got. So you're good. But yeah, that does help.
Cool, yeah.
Okay, so I'll just cover 2 more things really quick. For those of you who haven't met with me before, we are a correspondent, which means we have everything in-house. So we have in-house processing, like she was my processor, she's my TM now, but she works right next to me. We have in-house underwriting, we have no overlays. So I know exactly, I mean, my underwriter has worked till 10 o'clock at night on a file for me because I know her and she wanted to do me a favor. So we also fund and we service the loans. Occasionally towards the end of the month, we'll sell some of them, but that's why we can do everything really fast. So we have a 10-day close process. So here's some flyers I'll pass around. If you're not familiar with that yet, that's how we can help people compete with cash buyers in this market. So we fully underwrite them. We do guarantee them to close. We will guarantee their earnest money up to $10,000, subject only to title and appraisal at that point in time. And we do order a rush appraisal on all of those. We do have our in-house appraisal management company, which is how we know those guys can give us a quick turnaround. We know who we're working with. We know they do a good job. That does not work for VAs for USDA either though, because those are rural and we do not control those appraisals. So lunch is here. I just really quick, one more fun thing I just wanted to offer. So last fall, I got to be the sponsor for the Moms in Real Estate panel. And there was one topic that kept coming up, and it was feeling safe as a woman doing open houses and showings. So I hired a guy, a top UFC fighter, to come and teach us a self-defense class.
Nice.
It is next Tuesday. It's completely free for you guys, but he is one of the top in the industry. So it's next Tuesday. It's in Salt Lake at the pit at his studio, and it's just completely on me because I care about you guys. I'll come and I'll help at open houses when I can, but I can't be at all of them. So I just wanted to give you guys some tools. Yeah, it's women only. But yeah, I hope you guys, if you can make it, please RSVP because it is a limited amount of space because he is gonna be, throwing you around a little bit, so.
That's awesome that you recognize that. I just realized that didn't even come up in the second panel.
Oh, it didn't, okay.
Interesting.
Yeah, I've been
But
working
was a
on it
topic.
for a while.
Nice.
Took me a while to find someone I trusted to do that. So, thank you.
Awesome, thanks, Debbie. All we got, Nate, you're the sole survivor. Thanks, buddy.
Hey, I'm here for you, man.
Love you, dude. Hey, who was it? I think it might have been Sydney. She'll have to reach out to you. Somebody put in a request, or Ashley, to get some Team Limitless gear on your store for kids. So I'll talk to you later about that.
Oh, sure. Yeah, I'll take a look.
All right, man. Okay, we're out. See you.
All right, have a good one. Bye.